Excellent. The ATR, ability to repay dash QM. What's it stand for again? Quality mortgage, qualified mortgage? I forget. Means nothing to me. I don't care because we do all like that anyway. So the terminology doesn't matter. There are two foundations. Did I talk about this earlier with you guys?
Yeah.
Two major foundations in mortgage lending. There's more, but these are two major ones. One is somebody's income. That is their cash flow, their ability to repay a mortgage. Are you with me? So let's say we have somebody, what's your name? Krista. Krista? Krista. Krista. Okay, I got you. Hi, Krista. So Krista, a borrower comes to you, they got $20,000 a month in income. They take out a $500,000 mortgage, the mortgage payment is $3,000 a month. You gonna give them a loan? How many people say yes? Who said it? It depends is correct answer. Would you like to tell me why it depends?
Because each person is different.
How different are they?
Because you have to consider all of the factors that go into her,
$20,000 a month.
$20,000 a month. Because just because she's making $20,000 a month, her expenditures could be $18,000.
We're going to talk about that later, about the debt-to-income ratio, because that is absolutely correct. So here's what happens. They got the money coming in. The answer is depends. Just because they have $20,000 a month coming in doesn't mean that they're good. So that's their ability to repay. If you look at their credit is their willingness to repay. So if they make $20,000 a month, they certainly can afford $3,000 or $4,000 a month in payments. We know that. They have the ability to repay. But what if their credit score is 11? All right, too low? 12. I'll make it 12. So they have the ability to repay, they just don't pay anybody back. We're not giving them a loan. Are you with me? Now on the other hand, I might have somebody that works at McDonald's for the last 5 years making $20,000 a year. They have a Macy's credit card for $500, or a charge card rather, a JCPenney charge card for $500. They buy shoes and clothes and everything. They pay back all the time. They may have a credit score of 800. Am I giving them a loan for $500,000? Why not? They don't have the ability to repay, although they have the willingness. You have to have both the ability to repay the loan and the willingness. What's that? Ready? Well, if you bring somebody to buy a house that's ready, willing, and able, what's that called? A meeting of the minds. Okay, so let's go back to loan to value. We're going to actually do some of these things that are on here. So, loan to value is nothing more than what percentage of the value of the home that was borrowed. Fair enough? Now, any of the guys here on this side here, when you were in high school, cut class because you didn't think you need math? Anybody? I'll take you out. Your son raised his hand. We're going to pretend that you cut class, all right? All right. So George and I, we went to school together. Algebra, trigonometry was coming on, and he's out in the back of the schoolyard cutting class because we need this, right? So he's standing out there with me, and he goes like this, "Yo, Doug, we'll never need that crap, right?" How many people thought that when they got into business or did something when they got older wouldn't need those kind of algebra, trigonometry, equations, right? A lot of us, right? To be fair. I'm going to teach you how it actually works so you know what's going on with your customers and borrowers. Would that be good? Okay. So, we call it loan to value. The acronym is LTV. What's the LTV? That's the acronym for loan to value. Fair enough? But this is a formula. We need to come up with a percentage. With a percentage, that means that something is gazintus. Something's going into something, right? It's going to be division. LTV, just go like this. You put a dividing line through the T. Loan divided by value equals. Loan divided by value equals. That's the formula. What's the formula? Say it nice and loud. What's the formula? Are you asking me or telling me? You're telling me. All right. What's the formula? Nice and loud. I'll work it with you. Ready? Loan divided by value. That's right. What is it? Nice and loud. What is it? Loan divided by value. Excellent. See, the people over there think I'm not going to pick on them. Hi, how are you? What's your name? How about this whole section back here? What is it? Excellent. Everybody together. What do we call it? Loan divided by value. So, the formula is loan divided by value. We know what the formula is, right? I'm not going to go deep into this. I just want to ask a question. In a purchase transaction, what determines the value of the property? Who said the appraisal over here? Hi. What was your name again? Hey, Jack, you want to put $1 on your answer? Let's see that dollar. There's no gambling in my casino without the money out on the table. Oh, another guy with only hundreds. All right, here we go. Nice. All right, that's an incorrect answer. Yeah. Okay, does anybody know what the correct answer is in a purchase transaction?
Contract price?
The buyer, that's part of it.
What the buyer is willing and able to pay for it.
What the buyer is willing and able to pay for, that's part of it.
Market conditions.
Market condition, part of it. All right, I'll give you the answer. This is in your 75-hour book. By the way, how many people here have opened up their 75-hour book after they graduated class? Anybody? I'm guessing. What's a 75-hour book? All right, hold on a second. That's $1 right there. Some of you have it under your coffee table in the living room so the coffee table's not rocking back and forth. Who said they opened it up? You opened it up? That is part of it. I'm going to give you the full answer now. You're on the right track. It's what a seller is willing to sell for, a buyer is willing to buy for, in a free and open marketplace where there's no undue pressure on the seller to sell, no undue pressure on the buyer to buy. In what type of a transaction? Arm's length. You don't know me, I don't know you. How much are you looking to sell your house for? As much as you can get. That's the correct answer, am I right? Yes. Because if you're looking to get $425 and I offer you $600, will you take it? Yes. Every single day of the week, right? So we don't know each other. You're looking to get as much for your house, and I'm looking to buy it for as little as possible. We talked about this in the appraisal class this morning, did we not? That's exactly right. So you're looking to sell your house, let's say $800,000. I offer $750. We go back and forth. We agree on $775. We have an agreement, a contract for $775. Let's say the appraisal comes in at $800. Which value does the lender use? $800,000 or $775? They use $775. Why? Because it's the contract price? You were in my class this morning, weren't you? I want you to hear what the correct answer was, because you were in my class this morning and you remember this. What do we use? The lower of the appraised value or the purchase price. So, if it's the other way around, and I offer you $800,000 on your house and it appraises for $775, we use the $775. It's the lesser of the appraised value or the purchase price, whichever is less in a purchase transaction. However, in 99% of the cases, the appraised value comes in the same as the purchase price. Because the appraiser is only giving their professional opinion of the value of that transaction. And it's important that it's a arm's length transaction. Because let's say we're related. Okay? I'm the much older brother. I got married 10 years ago. I got my house worth $800,000. My wife and I are doing good. We're going to move out to California next year. You just got married this year. Instead of us writing you a check, we say, listen, you're married now. I know you want to buy a house. We're going to sell you this house for $600,000, give you a $200,000 gift of equity. Would you like that? Good. So I got my brother. He started out. The purchase is $600,000. Is that a true value of that house in that market? No, it comes in at $800,000. That's a non-arm's length transaction. So, in a purchase market, it's the lesser of the appraised value or purchase price. By the way, have I been hitting on most or else all cylinders? Anything you want to add? Anything you want to add? 39 years in the business, 12 years in the business, 2 other loan guys in the office. I don't know who they are. I'm up here babbling. It's okay for you guys to disagree on anything that I say. Like you don't like the suit I'm wearing, anything like that. But so far, pretty much straightforward, everything we're talking about here. And is this really going in very, very deep, or is it the tip of the iceberg? Tip of the iceberg for a lot of stuff, right? Yeah, a lot of work goes on behind it. So, I handed out to you guys. What's what? Question? Hi. Come on in. We're just finishing up the time management portion of the class. Oh, so, you see I have the 3 igloos here. They're all worth $100,000. Below that I have the mortgage balance that's outstanding on each one of those. I want you guys to take a minute and figure out, you can write right on there, what the loan to value is for all 3 of those properties. This should take about 2 seconds. Wow, look at all these people working hard. I went to a CE class and I wanted to sleep. He's making me work. Okay. Show of hands, who wants to answer number 1? What did you come up with? Are you asking me or telling me?